Silver hit $62. The dollar just died. Fed surrenders. We are witnessing a historic dislocation in the global financial markets that most people on Main Street are completely oblivious to right now. While the average American is distracted by political theater and the noise of the news cycle, the real story is being written in the quiet corners of the commodities exchanges. Today, silver didn't just move. It sent a flare into the sky that signals the end of the old monetary order. We watched silver shatter yet another ceiling, coming within pennies of $62 an ounce at the session high. This is not just a price movement. It is a scream from the engine room of the global economy that the pressure gauges are broken. When you see a metal like silver, which has been suppressed and manipulated by the paper markets for decades, suddenly wake up and sprint towards $62, you have to ask yourself what broke. The price action we saw today, reaching a high of $61.97, is the market forcing a reality check on the central planners. We are creeping back up in overnight trading, and the momentum is undeniable. But the question everyone is asking me is the wrong one. They ask, when will it stop, expecting a crash. The real question you should be asking is, why is it moving like this when the volume is vanishing? That is the telltale sign of a market that has run out of physical inventory. We saw something fascinating today that the mainstream financial press will gloss over. As the price of silver rocketed upward, the trading volume actually decreased. In a normal, healthy market, you expect rising prices to be supported by a flood of new buyers. But today the volume tapered off, yet the price kept climbing. This tells me we are entering a liquidity crisis on the sell side. The sellers have left the building. There is nobody left willing to trade their hard assets for depreciating paper dollars at these levels. We are staring at a scenario where the paper price is being dragged kicking and screaming to meet the physical reality. It is a classic short squeeze dynamic, but on a macroeconomic scale. The bullion banks and the high-frequency traders who usually step in to smash the price down with paper contracts were nowhere to be found. Why? Because they know they are cornered. When volume dries up and price spikes, it means the order book is empty. If you want silver, you have to pay the offer, and the offer keeps moving higher because the holders of real wealth are not selling. Let's zoom out and look at the catalyst that supposedly triggered this, although I argue the fuse was lit long ago. The Federal Reserve concluded their open market committee meeting and did exactly what the smart money expected. They cut rates by 1/4 of a point. The target range is now down to 3.5 to 3.75%. The Fed chair, Jerome Powell, came out with his usual vague, bureaucratic language, claiming that inflation remains sticky. Sticky is a polite euphemism for out of control. They are admitting they cannot get inflation back to 2% without crushing the economy, so they are capitulating. This rate cut was, frankly, an admission of defeat. The markets have already priced in a slow, agonizing death for the dollar, and the Fed is just stamping the paperwork. Powell hinted that we might only see one rate cut in 2026 and another in 2027. Think about the absurdity of that guidance. They are pretending they can forecast the economy 2 years out when they didn't see this inflation coming 2 years ago. The bond market isn't buying it, and the precious metals market certainly isn't buying it. They are cutting rates into sticky inflation. That is the recipe for stagflation, a nightmare scenario we haven't truly seen since the 1970s. However, there is a wild card in the deck that we need to address. The political landscape is shifting, and the markets are trying to front-run the next administration. There is rampant speculation about who Donald Trump might nominate for the Federal Reserve. The smart money is betting on a dove, someone who will aggressively cut rates to juice the economy, regardless of the inflationary consequences. If a new Fed chair comes in and slashes rates by 50 basis points or more next year, the dollar is going to be taken out behind the woodshed. Silver is sniffing out this pivot before it even happens. We have to look at the scoreboard because the numbers do not lie. The US dollar index, the DXY, is the report card for American economic strength, and today it failed miserably. It dropped notably, crashing below the 99 handle to sit at 98.67. That is a massive move for a currency index in a single day. When the dollar loses 0.5% of its purchasing power against a basket of other fiat currencies, which are also garbage, it tells you that capital is fleeing the greenback. It is seeking safety, and for the first time in a long time, it is finding that safety in silver. Let's look at the breakdown of the metals because the divergence here is critical. Gold is doing its job, up about $19 to over $4,200 an ounce. It's a steady, relentless march higher. But silver is the uncoiled spring. It is up almost 2% today, trading over $61.80. While gold is the shield protecting your wealth, silver is the rocket ship. It is outperforming gold on a percentage basis, which is exactly what we expect to see in the late stages of a bull market. The poor man's gold is becoming the wise man's primary asset. Here is a statistic that should make the hair on the back of your neck stand up. Silver has now surpassed the price of oil. With silver sitting at nearly $62 and a barrel of crude oil trading around $58.95, we have crossed a psychological Rubicon. In theory, you could trade a single 1-ounce coin of silver for a barrel of oil. That is a profound shift in relative value. It highlights how undervalued silver has been and how undervalued energy has become relative to the monetary debasement we are seeing. The commodities complex is realigning, and silver is leading the charge. Contrast this with the industrial metals. Platinum and palladium took a beating today, down sharply by well over 2% each. This is a very important signal. Platinum and palladium are largely industrial playbooks, automobiles, catalytic converters. Their drop suggests the market is worried about a recession, a slowdown in manufacturing. But silver, which is also an industrial metal, ignored that data. Why? Because silver is reclaiming its monetary status. It is decoupling from the industrial complex and trading as pure hard money. It is behaving like a currency that cannot be debased. Now I want to address the skeptics and the nervous investors who see this vertical price chart and get vertigo. Yes, we are in uncharted territory regarding the nominal price. We have never seen $62 silver in terms of today's dollars. But you have to stop thinking in nominal terms. A dollar today is not a dollar from 1980 or 2011. If you adjust for the government's manipulated CPI numbers, the 2011 high would be $74 today. If you use the 1980 high, we would need to see silver over $213. We are not even close to the real all-time highs. This perspective is essential for maintaining your composure in a bull market. The volatility we are seeing, where the price swings violently at the $60 level, is just noise. The trend is up because the fundamentals of the dollar are down. However, we must be realistic. Nothing goes up in a straight line forever. I expect to see periods of stagnancy. I expect the cartel to try and paint the charts to induce panic selling. We might see a consolidation period where the price pulls back to test support. That is healthy. That is normal. Do not let them shake you out of your position. We saw this volatility play out in real time today. Earlier in the session, silver was actually down. It looked like the rally was losing steam. Then, seemingly out of nowhere, the fire was lit in late trading. That reversal is what we call a key reversal day in technical analysis. It shows that every time the price dips, there are whales waiting with their mouths open to swallow up that physical metal. The dip buyers are aggressive. They are not waiting for a bottom. They are front-running the inflation that they know is coming down the pipeline. The yield on the 10-year Treasury note is sitting at roughly 4.16%. In a rational world, a 4% yield would be attractive. But in a world with real inflation running at 6, 7, or 8%, that bond is a certificate of confiscation. You are losing purchasing power by holding government debt. This is why the bond market is broken. The only buyer left is the Fed and the captive banking system. Investors are waking up to this math. They are realizing that the risk-free return is actually return-free risk, and that money is flowing into the only assets with zero counterparty risk, gold and silver. I want to circle back to the volume anomaly because it is the most important data point of the day. Around 2:00 p.m. Eastern, we saw radical movements up and down with heavy volume. That was the battleground. That was the shorts trying to cap the price and the longs absorbing the selling pressure. But by 3:30 p.m. the volume tapered off, yet the price shot right back up. This indicates seller exhaustion. The bears fired their last bullets, and the bulls are still standing. When the selling pressure evaporates and the price drifts higher on low volume, it means the path of least resistance is up. This leaves me scratching my head, not because I don't understand why silver is valuable, but because of the mechanics of this specific move. It suggests a structural break in the mechanism of price discovery. The paper market, the COMEX, is losing its grip. For years, they could print infinite paper silver to suppress the price. But you cannot print physical ounces. Eventually, the manufacturing demand and the investment demand collide with a fixed supply. We are seeing the early tremors of that collision. The tail can no longer wag the dog. Let's talk about the takeaway for you, the individual investor. If you are sitting on cash, you are the patsy at the poker table. The Federal Reserve has told you to your face that they will cut rates and let inflation run sticky. They are telling you they are going to devalue your savings. You have to take action. This is not about getting rich quick. This is about not becoming poor slowly. Physical ownership is the only insurance policy that pays out when the system fails. And make no mistake, the system is failing by design. If you are looking to buy now, you might feel like you missed the boat. You look at $62 and think, I'll wait for a pullback, and maybe you will get one. Maybe silver drops to 55 or 50 next week. But maybe it goes to 75. The risk of being out of the market is now greater than the risk of being in it. Dollar cost averaging is your best friend in this environment. Buy a little bit consistently. Do not try to time a rigged market. Just accumulate ounces. Measure your wealth in weight, not in the paper promises of bankrupt politicians. There is a psychological aspect to this that we need to master. When silver hits these record nominal highs, the temptation to sell and take profits is immense. You see that number in your portfolio and you want to cash out. But cash out into what? Into a dollar that is crashing below 99 on the index. Into a bond market that is mathematically insolvent. If you sell your silver now, you are trading a king for a pawn. You are trading hard assets for the very liability you were trying to escape. Do not be the person who sells their life raft to buy a ticket on the Titanic. The industrial shortage is the other pincer in this squeeze. We talk about the monetary demand, but we cannot ignore the green energy transition. Solar panels, electric vehicles, electronics, they all require silver. It is the most conductive metal on Earth. You cannot have a modern economy without it. We are draining the above-ground stockpiles at a record pace. The miners cannot ramp up production fast enough to meet this demand. It takes 10 years to bring a new mine online. The supply cliff is here, and the market is finally waking up to the scarcity. I mentioned earlier that platinum and palladium are down. This divergence is key. It tells us that capital is discriminating. It is not just a commodities supercycle lifting all boats. It is a flight to quality money. Investors are dumping industrial proxies and buying monetary insurance. Silver is unique because it wears both hats. It is an industrial necessity and a monetary metal. Right now, the monetary hat is the one driving the price. The market is pricing in a currency crisis, not an industrial boom. Let's look at the timeline. The Fed says one cut in 2026. The market says you're lying. The market is forcing rates lower regardless of what the Fed says. The bond vigilantes are back, but this time they are not selling bonds to spike rates. They are fleeing the dollar entirely. This loss of confidence is the death knell for a fiat currency. Once the psychology shifts, once the average person realizes their money is melting like an ice cube in the sun, the velocity of money picks up. People spend the currency as fast as they get it, chasing real goods. That is the tipping point. We are also seeing the premiums on physical bullion shift. Bullion dealers, the guys on the front lines, are seeing massive turnover. While some products are on sale as they try to balance inventory, the desirable stuff, the sovereign coins, the recognized bars, is getting harder to source in volume. When the retail public finally wakes up and joins this party, there won't be enough metal to go around. We are currently in the institutional accumulation phase. When the public panic phase begins, you won't be able to find silver at spot price. You'll be paying double if you can find it at all. I want to reiterate the oil-silver ratio because it is the most actionable signal today. Energy is the master resource. Silver is the master money. When silver buys more oil, it means silver's purchasing power is increasing in real terms. This is what we call financial sovereignty. It means your labor stored in silver is gaining leverage over the physical world. This is the opposite of inflation, where your labor loses leverage. This is why we stack. To preserve the energy of our work against the theft of the central banks. So where do we go from here? Short-term, expect volatility. Expect the bullion banks to try one last desperate smash. They might use the next inflation report or a geopolitical lull to dump paper contracts. If we see a pullback to $55, do not panic. That is a gift. That is the market letting you in one last time before the doors close. The long-term trajectory is written in stone by the sheer amount of debt the U.S. government has accrued. $35 trillion and counting. They have to print. There is no other mathematical option. The 2011 high of roughly $50 was a nominal peak. We smashed through that. The psychological barrier of 50 is gone. The next resistance is the inflation-adjusted number of 74. Once we clear that blue sky. And remember, in 1980, silver spiked because of the Hunt brothers. Today, we have millions of retail investors, sovereign wealth funds, and central banks all competing for the same metal. This is not a cornered market by two brothers. This is a global run on the bank. The fundamentals today are infinitely stronger than they were in 1980 or 2011. You need to prepare yourself for a world where $60 silver looks cheap. It sounds crazy now, just like $20 silver sounded expensive 10 years ago. But in a hyperinflationary or stagflationary environment, price is irrelevant. It is about availability. Can you get the metal? Do you own it? Is it in your possession? If the answer is yes, you are your own central bank. If the answer is no, you are a creditor to a bankrupt system. The choice is yours. We must also consider the geopolitical angle. The BRICS nations are accumulating gold at a record pace. They are building a payment system outside the dollar. While silver is not a central bank reserve asset in the same way gold is, it rides the coattails of gold. As the East de-dollarizes, they will turn to hard assets. Silver is the most accessible hard asset for the global population. The demand from India and China is already voracious. We are competing with billions of people for a finite resource. The Fed's asset rate cut, impotent and meaningless, is the final confirmation that the pilots have lost control of the plane. They are pushing buttons that are no longer connected to the engines. The economy is slowing, inflation is sticking, and the debt is exploding. This is the perfect storm for precious metals. It is the scenario that the hard money advocates have been warning about for 20 years. We were called conspiracy theorists. We were called fearmongers. Well, look at the board today. Who was right? Silver at $62 is not a bubble. The dollar is the bubbles. The bond market is the bubbles. The stock market, fueled by printed money, is the bubble. Silver is simply the pin that is waiting to pop it. When the correction comes, capital will flow from the fantasy world of Wall Street to the real world of commodities. You want to be positioned in the real world before that floodgate opens. As we close out this session, I want you to look at your portfolio and ask yourself a hard question. How much of your wealth is dependent on the promises of politicians? How much is dependent on the solvency of the banking system? If that number is 100%, you are in danger. You need to diversify into assets that have no liability attached to them. Silver is not an investment, it is wealth insurance. It is freedom. Even if silver prices get cut in half tomorrow, I would sleep like a baby. Why? Because I know that $31 silver is temporary, but the destruction of the dollar is permanent. Mathematics always wins in the end. You cannot print wealths. You can only print claims on wealths. Eventually, the market wakes up and realizes there are more claims than there is wealth. That is the moment of hyperinflation. That is the moment silver goes vertical. Do not get distracted by the daily fluctuations. Do not let the volatility shake you. The trend is your friend, and the trend is the collapse of fiat currency. We are witnessing history. We are watching the end of an empire of debt and the rebirth of sound money. It is messy, it is volatile, and it is scary. But for those who are prepared, it is the greatest opportunity of our lifetimes. Stay disciplined. Keep stacking. Ignore the noise. The volume anomaly today was the canary in the coal mine. The smart money is quietly exiting the burning theater while everyone else is watching the movie. Make sure you are near the exit. Make sure you have your medal. And remember, the price of silver isn't going up. The value of the dollar is going down. That is the only chart that matters. I want to extend a multitude of gratitude to you for tuning in and for being part of this community of critical thinkers. It is not easy to go against the grain. It is not easy to be a contrarian when the whole world tells you to buy tech stocks and bonds. But history rewards the patient and the prudent. Keep your powder dry, keep your stack high, and never trust a central banker. Until next time, stay safe and keep stacking.